Good afternoon, and thank you for joining us today. I'm Bruce Tatters, CEO of Red Cloud Securities. Today's webinar features Seabridge Gold, one of Canada's and the world's premier gold and copper exploration development companies, with all of its projects in politically secure regions of Canada and the US. Last week, Seabridge Gold announced the acquisition of the Snowfield gold property from Pretium. This transformative transaction brings 30 million plus ounces of reserves and resources deposit to Seabridge, adjacent to its Mitchell deposit at KSM. We are extremely privileged to have Seabridge here today, both an outlook on the gold market and an update today on Seabridge plans going forward. After the formal presentation, we will be taking questions live. Please send us the disclosures and then get into it. For Seabridge Gold, there may be some forward-looking statements made on this presentation. I would direct listeners to the cautionary note on the second page of the corporate presentation. For Red Cloud Securities, I would highlight that this webinar is for information purposes only and should not be considered a solicitation to purchase or sell securities or a recommendation. And we note that this call does not take into account particular situation or needs of individual investors. Participants should rely on their own investigations and seek their own professional advice before investment. Please see our most recent research located on our website for Seabridge Gold for specific disclosures. Now I'm going to turn the presentation over to Jim to begin. Jim?
Thanks, Bruce. Okay, so to start, I think I'd like to take a look at the economic outlook and compare our thoughts to what the market is currently operating on. The bulls are telling you to expect a rapid economic growth spurt in the first half of next year due to vaccines. And every time you get a vaccine announcement, positive one, you tend to get a little downdraft in gold, plus some added stimulus, but most commentators will say no inflation. Interesting enough, the inflation break-evens in the bond market are telling you that inflation expectations are on the rise, but that's another matter. We'll get to that later. In our view, serious damage has been done to corporate balance sheets. You're now beginning to see a second wave of cost cutbacks and reductions in capital expenditure plans. The labor market, which is critical to everything, is very weak and getting weaker. Consumers are at the breaking point, and therefore massive fiscal stimulus will be required in 2021, much of it financed by the Fed's quantitative easing. So looking at the labor market specifically, initial jobless claims are still running at about 4 times pre-COVID levels. This is extremely disappointing, very bad news. The latest ISM data, but the green fizzles out and it is now falling rapidly. Again, disappointing. And if you look at the chart on the right, just to note that 14 million workers face unemployment benefits loss at the end of this month, and the employment in small businesses, which came back to about half, they recovered about half of what was lost, is now trending downward again. So again, not good news on the labor front. And it looks like all the money that was spent last year, the huge deficits that were incurred, were not enough, and we're going to have to do it again. And just a few little highlights to indicate this. The U.S. Census Bureau predicts that 17.8 million adults are currently behind in rent or mortgage payments, and of those, 5.8 million will be evicted January 1, evicted or foreclosed on. That's a kind of frightening number. And if you look at Moody's, their estimation is that unpaid rents total about $70 billion currently, which is putting a huge squeeze on small landlords. And then conversely, in the third quarter, nearly 25% of household income came from government transfer payments. So that tells you why the recession, which is really very deep, has not been all that visible, because it's been papered over by the Fed and the Treasury. But if you really want to know the truth, 75% of Americans don't have $500 to meet an emergency. So what's going to happen? We're going to see a lot more stimulus, and it's going to be funded by the Fed. So if you look at the numbers, the deficit in 2020, which ended in October, was forecast to be 3.1 trillion, and it was 3.1 trillion. Federal expenditures were actually double tax revenues, which is pretty amazing. We're expecting to see another US $3 trillion deficit this year, and that will take the at year end the debt to about 30 trillion. And it's interesting to note that in 2020, the addition to the Fed's balance sheet was equal to the increase in the US debt. So it's obvious that the Fed is monetizing the US deficit. They may claim to be otherwise, but throughout the universe, in fact, that we know of, that's what's going on. Central banks are printing money for fiscal expenditure. And that's what makes it very different from the quantitative easing of 2008 to 2014, where the money stayed in the financial system. This stuff is not. So we think the Fed will have to do at least $3 trillion in QE this year to fund the deficit. Their current pace is just $1 trillion a year, about 80 billion a month. And I have to flood the market with new net issuance, and that will put pressure upward on interest rates. At the same time, we have markets that the Fed can't afford to see rates go up, certainly not anymore. And most people who've compared COVID-19 to the Second World War, they might have a point in terms of fiscal and monetary management. So if you look at this chart on the page now, the blue line looks at the inflation-adjusted 10-year Treasury rate. It's been plunging as gold. The red line has been rising. Then you see at the end, the blue line pops up and the red line pops down. And that tells you all you need to know about the gold price and where it's going. And it also tells you why the Fed will not want that blue line to continue, because, as we've said, there are just too many companies and an economy itself that cannot stand for higher rates. Low rates are built into the US economy now, and it cannot be changed except during a terrible crisis, which we hope not to see. So moving on to the next slide, we're therefore expecting gold-friendly Fed policy in 2021, consisting of increased quantitative easing and fiscal stimulus, which will further weaken the US dollar. We note that it has broken its 52-week low in the last couple of weeks and is looking rather pathetic, even though there's an all-time record short position in the US dollar, which should have caused a bounce by now, but it's not there. And we'll see yield control, which will lower real yields, which is the biggest boost you can give to gold. And in fact, we think the big trade next year is going to be low yields, driving investors out of bonds and into gold. If you look at the numbers, they're really quite amazing. 80%, this is courtesy of Ray Dalio, 80% of global debt in local currency yields less than 1% before you take into account inflation. So obviously all negative yielding. And US corporate bond yields are now, for the first time ever, negative after you take into account current inflation expectations. So overall, we therefore think that the gold bull market has just begun. The global supply of gold grows at about 1.3% a year. How about 28% for US dollars currently, year over year? Global above ground gold is less than half of 1% of total global money supply, also expressed in US dollars. And gold's share of global assets is less than 3%. It's been much higher, and we think it is going much higher. And you see that chart on the right. So all considered, we're looking for $2,500 gold by mid-year next year. And it won't be a surprise. It'll be a direct result of stipulated Fed policy.
We also hold 100% of the world's largest undeveloped gold project that also has significant copper, over 100 million ounces of gold since 2007. We now have 3 new explorations. When we formed the company in 1999, we tried to do something a bit different. Our industry is hell-bent on turning gold into cash, and for the most part, not doing very well at that. When we formed Seabridge, our goal was to create what we thought would be the best leverage play to a rising gold price. And we do that through the simple concept of turning cash into gold. We suffered dilution to grow assets either through acquisition or exploration. Our goal from day one was to build a company that provided more gold ownership per share than any other company on the planet. The way we implement this is making sure that we grow ounces in the ground faster than shares outstanding. And if you see what we've delivered on now over the past 20 plus years, we've delivered on that concept. As Bruce mentioned, on Friday last week, we announced the acquisition of Snowfield, which I'll spend some time on today in the presentation. But that allowed us to have a big jump from 2019 to 2020, adding 35 million ounces of gold resources. In fact, by issuing the 6.1 million shares we sold to pay for this acquisition, in essence, we got over almost 6 ounces of gold per common share for that acquisition. If you look at us now compared to other gold companies, I believe that per share metrics are still very, very important. And one per share metric we look at is our reserves per share or our gold resources per share. And as you can see on these slides side by side, whether you look at reserves per share or resources per share, we provide 5 to 50 times more gold ownership per share than other companies in the industry. And what that has translated into is what we were hoping for when we started Seabridge in October of 1999. And that was significant outperformance in our share price relative to the gold price or other gold equities. And as you can see on this chart here, we've delivered on that. Over the long haul, our shares are up nearly 9,000% compared to an increase in the gold price from the time we began of about 500%. And then if you look at those periods of time when gold is in a strong upward trend, like from 2004 to 2007, and then again coming out of the financial crisis in 2008 to 2011 when gold hit its prior peak of 1900, and then again coming out of the bottom of 2015 when gold went down to $1,000 from the 1900 in 2011, and now is back approaching all-time highs again. As you can see, our shares really do well in a rising gold market. If you want ownership in a stock that's going to give you the best performance in a rising gold market, or just want to own something that's going to give you portfolio insurance, we have a 21-year track record of showing that significant outperformance, and it should be no different from this point going forward. In fact, it should be better, because today we're sitting with more ounces of gold per share than we've ever had in our history. Turning now to our assets, we have a very tight geographic focus. In mine and Jim's career, we've had mines expropriated in third world countries. When we formed Seabridge in 1999, our goal was political safety. And as such, we only focus in Canada and the United States. And as you can see here, most of our projects are located either in Western Canada or the Western United States. The most important project we have in our portfolio is KSM, which we acquired from Placer Dome in June of 2000. When we bought this project, known resources at KSM were about 3 million ounces of gold and 2 billion pounds of copper. Placer Dome had spent about $25 million back then delineating those resources. If you fast forward to today, we've now spent $300 million in advancing KSM and just recently announced the acquisition of Snowfield to add to the resources that eventually reserves at KSM. As a result, KSM can now report, once we close on the Snowfield acquisition, 142 million ounces of gold in all resource categories, over 50 billion pounds of copper, and over 700 million ounces of silver. It's not just the ounces here, it's also what we've done with the project from the engineering perspective and the permitting perspective. We've now engineered a project that has now gone through the environmental assessment approval with certificates in hand. To get to that point, we've also received the support of the local indigenous communities with impact benefit agreements in place with both the Tahltan Nation and the Niska Nation. Another big advantage to us is what's happened in terms of infrastructure that's actually been built with other people's money. When we bought this project in 2000, there really wasn't much there in terms of infrastructure. Today, we now have 2 new ports in the town of Stewart that will give the project year-round access to bring supplies in and take concentrate out on a year-round basis. We also have a major highway just to the east of KSM, Highway 37, that is maintained year-round by the government and actually ties into the Port of Stewart. And then last but not least, but probably most important, is the governments of Canada have now spent over $700 million extending the power grid and bringing cheap hydro power to the region. We've now secured with BC Hydro through contracts 250 megawatts of power from this line that we'll be able to buy off the grid for about 5 cents per kilowatt hour. Having that type of cheap power at KSM really helps drive the economics. If you look at KSM before the Snowfield acquisition, we had 4 deposits from top to bottom: Ironcap, Mitchell, Sulphurets, and Kerr. Collectively, these 4 deposits give us 7.6 billion tons of resources, which contained 107 million ounces of gold, 46 billion pounds of copper, and 600 million ounces of silver. As we went through the environmental assessment process on these 4 deposits, we have now approved a tailings facility that can hold about 2.4 billion tons of tailings in the approved space. So even though we've had 7.6 billion tons of resources, we've been looking at what are the best 2.4 billion tons that we can mine to fill up that tailings capacity. We finished a pre-feasibility study in 2016, which is the basis for our approved project. That study captured 39 million ounces of proven and probable gold reserves and just over 10 billion pounds of copper, and showed a decent project at the gold price of $1,230 and $275 copper, but obviously a much more robust project at today's metal prices. What that mine plan did not yet include, however, are the additions we've made to KSM since that 2016 pre-feasibility study. We've now added at Ironcap and Deep Kerr over 40 million ounces of gold and 29 billion pounds of copper. Earlier this year, we actually filed an updated technical report to show what the impact of Deep Kerr and Lower Ironcap would be on the project by developing those as large block caves, and that showed a significant improvement in the project's economics. And you can go back and look at the estimates on that in the April 2020 technical report. What that did not yet include, however, is what we've now added as a result of the addition of Snowfield. We've been looking at this asset, Snowfield, since 2008, actually before Pretium even owned it, when it was owned by Silver Standard. We obviously had dialogue with Pretium as soon as they purchased this project, when they purchased Snowfield and Brucejack from Silver Standard for $500 million in cash. Back in 2011, we did joint studies with Pretium to look how Snowfield might be able to fit into the greater KSM, and even back then it made a lot of sense. The problem was always how much would we be willing to pay for it relative to the kick we would get in terms of net asset value. And it wasn't until recently, when Pretium had a change in management and started to focus on the concept of debt reduction, that we were able to step in and do a deal, which I do believe is a win-win for both companies. Pretium will get to book $100 million in cash that they'll be able to offset debt with, and we're booking 35 million ounces into our project, which can be quickly implemented into a new mine plan. We expect to close this transaction next week. This morning, you'll see we announced the completion of a bought deal financing, closing that. The underwriters on that not only did the base of 105 million, but also exercised their 10% green shoe on top of that. So we closed on this morning on $115.7 million in cash proceeds that we'll use 100 million of which to pay Pretium next week to complete the acquisition. Now, what does Snowfield do for us? Well, it does a lot of things. Obviously, it's right next door to KSM. In fact, we believe that the Snowfield deposit is the sheared off top of the Mitchell deposit that tens of millions of years ago was just moved down the valley by a major fault. So I guess you can think that Snowfield is now coming home to where it belongs. It's a nice way to think about it. But from our perspective, ounces per share is important to us. As I mentioned earlier on, we issued 6.1 million shares for the base here. We got 35 million ounces. So we got almost 6 ounces of gold per share on the front end. Or to think of it another way, we're buying ounces in the ground at a deposit that sits right next to our core asset for about $3 an ounce in the ground. What really excites us, though, is what our belief on how Snowfield can be integrated into the greater KSM. As I mentioned, we did studies earlier on with Pretium showing that this would have a meaningful impact. Right off the bat, because a big portion of Snowfield's resources, of the 35 million ounces of resources at Snowfield, 26 million ounces are measured and indicated, which means that a portion of those can go right into reserves with additional work. Our reserves now at KSM are about 39 million ounces of gold. We believe that as a result of Snowfield coming into the KSM mine plan, that reserves should go up materially in our next mine plan. The other great thing about Snowfield is that it actually can fit within our approved project facilities. We don't need to design new waste dumps. We don't need to design new tailings facilities or any infrastructure. Everything that's designed now for the project and approved can be used to implement Snowfield into the mine plan. What we will need to get is a change in our mining permit, allowing us to mine that deposit within the greater KSM project. We think that that actually is a positive, though, however, because if you look at the strip ratio at Snowfield at less than 0.5 to 1, bringing Snowfield into the greater KSM project will actually reduce the amount of waste rock that has to be mined and stored. In fact, we believe we'll be able to show a mine plan that goes on well beyond 30 years of open pit material only, averaging about 1 million ounces of gold production a year over 30 plus years. Show me a project in the world today that comes close to that. We've also done enough metallurgical test work in the past, and we'll do some more this coming season, that confirms that Snowfield ore can be mixed in and blended with Mitchell ore without impacting recoveries or the specifics of the concentrate this project will produce. And finally, and maybe most importantly, is what our expected impact is on the project's important financial metrics. As a result of Snowfield coming in and being able to show a project that has all open pits for multi-decades, it eliminates the need for block cave development. So you actually can take out billions of dollars of sustaining capital that doesn't have to be spent. And because the first several hundred million tons of Snowfield comes at much higher grade in terms of gold than our reserves, we're expecting to have a significant, meaningful improvement on the project's net present value, internal rates of returns, payback periods, and other financial metrics. So stay tuned. Our plans at KSM over the next 12 months is to do the work that's necessary so we can implement Snowfield into the greater KSM and come up with an updated pre-feasibility study, redefining the project, incorporating Snowfield as open pit only with much better economics than we have today. And last but not least, and probably most important from us from a deal perspective, we've been saying for some time that we expect KSM eventually to be a joint venture with a major mining company. Those discussions continue even in the face of COVID. What we'll be able to show now in terms of our joint venture discussions is a de-risk project, much better economics, a project more focused on gold, and delaying any need to bring a block cave in early. So we expect that this also will be transformative in terms of our joint venture discussions. Remember, we have received proposals in the past from at least 5 different companies. We got close one time, not quite to the altar. We now believe, though, that with the addition of Snowfield, with the addition of metal prices we're now seeing for the first time, with copper at $350 and gold north of $1,800, and also last but not least, the need of big companies now to start thinking about replacing reserves because they're running out. The stars are lining up for us to get the joint venture terms that we've been hoping to get. I'll run through the rest of the portfolio very quickly and then have time for questions. Another big project we have is Courageous Lake in the Northwest Territories. At Courageous Lake, we have 11 million ounces of known resources, of which 6.5 million ounces are proven or probable gold reserves. We did a study in 2012, a pre-feasibility study that defined back then a marginal project, economic, but no one was going to spend the capital necessary for the returns being shown back then. One of the major detriments to the project back then was a very strong Canadian dollar relative to the US dollar. If you look at the same project with changing changing gold price and changing exchange rates, what was marginal back then looks very different today. Last year, we also did, in 2019, we also did internal studies confirming that there is a smaller, less capital intensive startup project at Courageous Lake, which might make sense. We're now evaluating what is the best path forward to unlock value for shareholders. which could include the outright sale of this asset or a joint venture. Let's not forget that in our 21-year history, at strong market environments, we've been willing to sell non-core assets as a way of funding assets that we could believe can drive additional value to our shareholders. One of those assets is Iskut, an asset we acquired in 2016 when we acquired a public company called Snip Gold. In fact, we believe that Iskut has the makings of another KSM, same age of mineralization, same types of rocks, same structural elements that led to the mineralization at KSM. We're now focusing on porphyry opportunities at Iskut. This year we had our first drill program that actually tested for a porphyry underneath the quartz-rise lithocap. We did get evidence of porphyry-style mineralization, although outside what we believe is the main system, and we're now evaluating what is the best path forward for a follow-up program in 2021. We also have an asset in Nevada called Snowstorm, an asset we acquired from John Paulson that sits right on the intersection of the Getchell Trend, the Carlin Trend, and the Nevada Rift Trend. Great address in Nevada with two large mines just to the south of us at Twin Creeks and Turquoise Ridge. Our focus at Snowstorm is to find deposits that are analogous to Twin Creeks and Turquoise Ridge. Last year we had our first drill program there, confirming that we have the right rocks, the right structural elements. We're now in the process of our second drill program that'll probably run into 2021. We expect to complete about 5,000 meters. Most of that is core, vectoring into what we hope will be Twin Creeks and Turquoise Ridge style mineralization. And then last but not least is an acquisition we did at the height of COVID in the Yukon called Three Aces, a project that we have been following for a number of years. We bought this project from a company called Golden Predator by issuing them 300,000 common shares and a 0.5% royalty. It's a large project. Actually, you can think of it as a district, over 300 square kilometers, 35 kilometers of strike length, with very high-grade gold showings in drilling intercepts right at the surface. And if you look at these intercepts here, you have multiple meter widths of multiple ounces per ton. We believe that this project has tremendous potential in terms of high-grade potential, as well as also mineralization outside the known veins that is evident in some of the historic drilling. We've now built a 3D database on this project and all the data that's been collected historically. We're now working towards what will be our first drill program in 2021 and expect to launch that next year. So in terms of driving value, why invest in Seabridge? Well, historic leverage to the gold price. If gold is going higher, so are our shares. 100% ownership in KSM. The big companies need new projects. There's not many of them available, especially in safe jurisdictions that are already permitted. KSM checks a lot of boxes. An exploration portfolio that we think is second to none. We now have spent the last 4 or 5 years canvassing the market and bought 3 new projects, any one of which we believe can be a company maker. And then just to come back on Snowfield, I've been in the business for 40 years. I've done a lot of deals in my life. I can honestly tell you that never in my life have I found a project to do an acquisition on that comes with this type of value up front, but more importantly, that will be extremely accretive to our shareholders and create unbelievable value going forward. And then last, before we turn over for questions, Bruce, we are dual listed on the New York Stock Exchange and the Toronto Stock Exchange, a market cap of about 1.8 billion Canadian, about 1.3 billion US, tight share count. I think what we're most proud about in our history is after 21 years, we have less than 100 million shares outstanding. In fact, with this acquisition now, we have more than 2 ounces of gold for each share outstanding. Unprecedented business. So with that, Bruce, turn it over to questions for me and or Jim.
Thanks, Rudy. Terrific presentation from both of you. Before I just go over to the questions on the line here, I had one for Jim, if he'll permit.
Absolutely.
Jim, in the near term, it appears that there's sort of 2 prevailing forces tugging away at gold, fighting one another. One is obviously the vaccine rollout schedule, which has put pressure on gold, and the other one been the current economic situation that we sort of see ourselves in and the need for additional stimulus.
Yep.
The question is, the first sort of question I have, and I do have a follow-up, but I'll do this one first. What do you think prevails in the near term here? I know you have a good outlook for 6 months, but I'm just sort of curious as to your near-term outlook.
Near term meaning the next month or two?
Next 2 to 3 months, going into year end and early next year.
I think one of the things that's blocking us right now in terms of the gold price, as you said, we've had the news of vaccine and therefore the presumption of a better economy to come, but we don't have any clarity or visibility on what the stimulus will be. So we're going to need to see the election issues resolved. I know that the great majority of people think that it is resolved and that we now have President-elect Joe Biden, and that may be the case. But we don't have stimulus because we don't have him in the White House yet. If we get him there, then I think you're going to see very quickly a deal for stimulus, which will be backed by the Fed. If Georgia falls to the Democrats, you're going to see a very, very big deal. So if you're a gold fan, you probably want to vote for the Democrats taking Georgia in the Senate runoffs coming up. And that gives you one scenario, which I think would be an absolutely explosive move in gold in January. If the Republicans hold on to the Senate and there's still questions about who is president, then that's going to slow down the prospect for the stimulus, which is the only thing holding back gold at this point. And it means that the next 2 or 3 months, you basically have a lot of sideways action where anticipation of stimulus will somewhat support the metal, but you will have, in the meantime, a lot of enthusiasm about the economy and the fact that maybe you don't need gold as much as you might have thought you did.
Thanks for that, Jim. And if you'll just permit me to ask one follow-up, it's really sort of the one that I'm finding the most puzzling right now. And that is that the Federal Reserve has come out and said that they're going to hold rates at zero literally till the end of 2023. Where in their forecast period, they're expecting us to be back at full unemployment and back running above 2% inflation. So given that you've got a Fed doing all that, I'm sort of perplexed as to why the market is so fussed with any type of news that gives economic hope to those out there selling off gold, given the intention of the Fed to really run the economy hot. And that shouldn't impact the gold price other than upwards.
Right. Well, and it's had that impact on the dollar. We've seen that melt away.
That's right. And gold not respond.
Yes, because of the interest rate factor. Yields have been the dominant factor in the gold price in the last 3 to 4 months. It hasn't been the dollar. So that's why really a critical factor in our perception of what happens to gold in 2021 is that the Fed will not allow these higher rates, the higher yields, to stand. They must bring those rates down. They've signaled that they're going to do it on the short end. Now they're going to have to do it on the long end as well. The run up in the 10-year yield may not seem like a lot, from 0.6% to 0.95%. But that is a lot in terms of the way the U.S. economy is set up. So I expect that will be a determining factor for the gold price in the coming year. The move toward yield control, we know it's been discussed at FOMC meetings. I believe we'll get an announcement on that in the first quarter.
Thanks, Jim.
Okay.
Now on to the questions on the line. Rudy, this one's for you. When do you expect to release the updated PFS for KSM?
When it's done.
Any sort of timing that you're thinking?
So we're planning a field program. We're going to go in and do some more metallurgy. We'd like to do test work actually that can take it not just to PFS standards, but to a feasibility standard as well. So we're going to be doing some geotechnical drilling in 2021. We'll be doing some more metallurgical test work now that we have different types of deposits to play with as well. We'll also be doing just some reserve confirmation drilling there, which is the right thing to do when you buy an asset. We'll have to update some water studies in terms of the impact of Snowfield into the waste dumps as well as the tailings. So all that work will be done in 2021. We would hope to be in a position to have an updated pre-feas done by the end of 2021 or early into 2022. That's our plan.
Okay. Next question again for Rudy. The major advantage of acquiring Snowfield is the deferral of development capital for deep core and iron cap block caves. How long does it defer it? Do you expect there to be any impact on initial capital and or sustaining capital?
Now, the one beauty of bringing Snowfield in, there is no change on initial capital. All the facilities that make up the initial capital are the same whether you have Snowfield or not. The only thing that changes is the mining sequences of now having 5 deposits to deal with. It's a function of what the partner wants. If a partner wants to drive copper production, they would move to bring the block caves in sooner. If the partner wants to drive gold production, they can go on for decades of open pit mining and not worrying about the block caves driving higher grade copper. We've done some internal studies already to show that you probably don't need to start developing your block caves if you want to get to block caves for the first 10 to 15 years of the mine life. And if you want to wait beyond that, you can. And what that does in terms of deferred capital, just in terms of looking at the sustaining capital that goes into the block caves, there's about $3 billion of capital in our sustaining capital number and our most recent 2020 PEA that actually it doesn't have to be spent if you don't want to.
Well, and Rudy, part of the question is also given that you can be open pit for a while, is there, the whole development and the tunneling to set up the block cave, does that drop the initial capex that was proposed?
No, there was no initial capital for the block cave.
It was always sequenced.
It was always sequenced, and that was the point, to try and drive returns back, a 1 to 2 time return before you actually started the block cave. No matter how you look at this project, you were always going to start with open pit at Mitchell because that drove the best economics. And now with Snowfield, it'll drive even better economics because I think there's about 300 million tons at Snowfield that come at better than a gram per ton right at the top of their deposit, which obviously helps drive production and cash flow earlier in the years than we have without it.
Okay. Next one. How will Snowfield, this back for you, Rudy, how will Snowfield affect the timing of a JV deal? And does a PFS need to take place?
No, it doesn't. Companies can do their own work. They've got all the data. They're going to be introduced to Snowfield in the next few weeks with a reach out to all the dialogue we've already had ongoing. We've done a lot of internal studies to show what our expected impact is if Snowfield not just is open pit only, but also what the impact would be for, say, a copper-focused company. When would be the best time to develop the caves to bring in iron cap and deep core and drive copper production relative to what we now have available up front. My belief is that it will be extremely helpful in our joint venture discussions. As I mentioned, we have turned down a number of proposals over the years. Our view has always been is that terms are far more important than timing. If we can now get the terms that we were expecting to get and hoping to get with this added benefit to the joint venture, we'll do the deal. And I believe that as a result of this, transacting on KSM, we've strengthened our hand considerably at the poker table.
Okay. Next question, again for you, Rudy, is if the TMAC deal fails, do you see an increased interest for Seabridge by Chinese interests?
We've had a lot of approaches by Chinese companies over the years, as you might expect. They are obviously focusing on grabbing as many resources as they can globally. Our view has always been from day one is that we're focusing joint venture discussions with a North American listed company that has built and operated mines safely around the world with existing and proven technology. We believe that we would not do ourselves favors by bringing in a Chinese company as the operator in terms of the rapport we built, not only with the regulators, but more important with the First Nations. A Chinese company could be there as a financial partner, but from our viewpoint, not as the operator of the mine.
Okay, so I'm just waiting to see, you've actually answered a follow-up on the Chinese side, whether you believe them to be a serious contender. So thank you for that. We got one comment for Jim out there. I guess it was related to my question. I will ask it, Jim, and I'll let you decide if you want to take it. The comment is, the Fed has no control over inflation. They can't force the banks to lend. Who cares about the Fed?
The Fed has underwritten the corporate bond market, which has enabled corporates to substantially increase their borrowings despite a risk-averse market. I think the Fed has an enormous amount of power, not over inflation ultimately. I think we're going to see inflation this time around, unlike the QE that they fostered in 2008 to 14. But their signals as to money and their availability of liquidity has been a significant player in the market. It's driven the stock market since March of this year, and it's driven the bond market by its support of corporate borrowing. It's prevented bankruptcies and created more zombie companies. So you can't say that it doesn't have a significant impact on the economy and financial markets.
And Jim, like many great economy watchers like yourself, you hear many like Ray Dalio speak to. There's eventually a tipping point with debt, where you get to the point where rates can't rise because of the bankruptcy equation. And too many people look at that 08 to whatever 2017-18 period where we added so much debt from a lower base, and the Fed was able to manage it. But I think it's a new ball game these days. But that's just casual sort of opinion.
Well, we have a growing percentage of the money that's being borrowed going into serving consumption rather than investment. We're not building the cash flow capability to service that debt at the same time that we build the debt. So there will be a tipping point for sure. Where it is precisely, no one knows. But it's definitely having a negative influence on growth. You can see that by the fact it requires more and more debt to accomplish the same amount of GDP growth.
Next one for you, Rudy. You have a very ambitious year next year in 2021 with this recent Snowfield acquisition in the KSM complex, plus some of your other assets. Do you want to just talk a little bit about the budget that you're planning for each of them, and a brief summary of what you're planning to do to progress each one of them?
Yeah, so we take our budget process 1 year at a time until we actually get the results from the previous year and assess the opportunities going forward. We don't have a pre-described budget set for next year. Next week, we'll have our corporate retreat, this year virtual, obviously, where we're all going to sit down and walk through what we did accomplish this year and what would be the likely plans and budget for next year. So that's an ongoing process that probably won't be finalized until sometime in late January. But at a minimum, we do expect to do the work at Snowfield to bring that up so we could do an updated pre-feas. We do expect to have a drill program at Three Aces. We expect to have a follow-up program at Iskut and a follow-up program at Snowstorm. So that's kind of laid out what the major components of the budget will be. Dollar amounts yet to be decided. I've always taken the view that actually, if you look at our history over 21 years, we've never had enough cash in the balance sheet at the end of the year to get through to the next year. We fund it as we need it, and I think that's what's kept our share count as low as it has, instead of just going out and raising dollars at the end of the year, then, let's spend it. So let's figure out what the programs are first, and then go raise the money to fund them. We are fortunate this year that as a result of the ATM we had in place, as well as the financing we just completed, where we had the $10 million oversubscription of the green shoe, we'll end this year with well over $40 million in our treasury, which is probably the largest cash balance we've ever had as a company at a year end. And again, and then funding whatever we may need on top of that for next year's programs, once those programs have been fully defined.
Terrific. Well, that is all the questions we have on the line, gentlemen. I really appreciate your time today. Red Cloud wants to thank Seabridge and want to thank all the viewers who tuned in today. a brand new part of the Seabridge story with this recent acquisition. We are all watching very closely, Rudy and Jim.
Thank you.
Thank you, guys.
Thank you, everyone. Enjoy the rest of your day.